Hey all, good afternoon. In this video we are going to discuss about the unobserved loss. Unobserved loss means a loss which has not been set off during the assessment year, so that will be carry forward for the subsequent assessment year. So in current assessment year, whatever the losses have not been set off, so that will be carry forward for the subsequent assessment years. So in subsequent assessment year only that will be set off. So that is what is called as unobserved losses. As far as unobserved losses are concerned, suppose as I told in the previous video, house property loss can be set off against either the house property income if possible. If impossible, it can be even set off against the interhead income also, other heads of income also, to the extent of 2 lakhs rupees other than the casual income, as I told you earlier. So that is applicable only for the current year losses. In current year, if you incur any loss, means that can be either set off with the same head of income or with the other head of income also, other than the casual income, to the extent of 2 lakhs rupees. But so if you carry forward the house property loss for the subsequent years, in subsequent year you will be you can set off the house property loss only with the house property income. So if you carry forward the house property loss, not only the house property loss, any head of loss if you carry forward, so you have to set off that particular carry forward loss with the concerned head of income only. You cannot set it off with the other head of income. So that is what is called that is what is the concept of unobserved loss. So here in the case of salary, there is no possibility of loss to arise. In the case of house property, so if the loss have not been set off in the current assessment year, though it will be carry forward, right? That is what is called as unobserved loss. So in the unobserved loss from house property can be carry forward for the 8th assessment year, next 8th assessment year, and then it should have to be set off only against the house property income whenever there is the income. Okay, so unobserved business loss can be carry forward for the 8th assessment year, and then speculation loss can be carry forward only for the 4th assessment year. So it will be set off only against the speculation business income, and then specified business loss can be carried forward for an indefinite period. There is no limit. There is no limit in terms of years for carrying forward the loss from the specified business, but it can be carried forward for an indefinite period, but it should have to be set off only against the specified business. That is very, very important. And then long-term capital loss can be carried forward for the next 8th assessment year, and then it can be finally set off only against the long-term capital gain. Short-term capital loss can be set off again, can be carried forward for the 8th assessment year, and then it can be either set off against the short-term capital gain or long-term capital gain also. Short-term capital loss can be set off against the short-term capital gain or long-term capital gain also. And then loss from the horse race can be carried forward for the 4th assessment year, and it can be set off only against the income from the race horse maintenance. Hope I made you clear. Just take a screenshot. This is regarding the procedure for setting up of losses. As per the provisions of section 72 subsection 2, brought forward business loss is to be set off before setting off unobserved depreciation. Therefore, the order in which the set off will be effected is as follows. First, step 1, if there is any current year depreciation, means first you have to set it off. So there are certain procedure for setting up of losses and the depreciation. First preference you have to give only to the current depreciation. which deals with the section 32 subsection 1. After setting off the current depreciation, you have to set off the current year capital expenditure on scientific research and current year expenditure on family planning to the extent allowed. If the current year expenditure, capital expenditure and family planning is there, means after setting off the current year depreciation, you have to set off the current year capital expenditure and the family planning. After setting up of current year depreciation and current year expenditure on scientific research and current year expenditure on family planning, then only you have to set off the carried forward loss, that is brought forward loss from the business or profession, that you have to thirdly you have to set off, which deals with the section 72 subsection 1. After setting up of brought forward loss from business or a profession, then only you have to think about the unobserved depreciation, section 32 subsection 2. So after setting up of unobserved depreciation, you have to set off unobserved capital expenditure on scientific research, section 35 subsection 4, and then finally you can set off unobserved expenditure on family planning, section 36 subsection 1, class 9. So first one, this is what is the procedure for setting up of losses. First one, you have to set off the current year depreciation if they have given in the question. After setting up of the current year depreciation, you have to set off the current year capital expenditure on scientific research and current year expenditure on family planning. Thirdly, you have to set off the brought forward loss from business or profession. After setting up of brought forward loss from business or profession, you have to set off unobserved depreciation. After setting up of unobserved depreciation, you have to set off unobserved capital expenditure on scientific research. After setting up of unobserved capital expenditure on scientific research, finally you have to set off unobserved expenditure on family planning. This deals with the section 36 subsection 1, class 9. Thank you. Subscribe. Thank you.